Dear friends, in this video, I'm going to cover why bank reconciliation is important for small businesses. My name is Jayanti Ganapathy. I'm the owner of Finaccurate. We are an accounting firm based in Boston, Massachusetts. Let's get to this topic. So, first of all, what is bank reconciliation? Bank reconciliation is a statement to reconcile between the balance in your bank statement and also the balance that you record in your accounting records, whether you are using a QuickBooks or Zero, whatever accounting records you are maintaining. It reconciling the balance that shows in your accounting records to the bank statement that you receive either monthly or whatever frequency. Make sure those two balances matches. That way you are not missing any information. So what are some of the reasons why these numbers can be different? It could be you issued a check, but it's still not been presented. You would have already recorded that as a payment in your accounting records, but it is yet to show up in your bank statement. So that can cause a difference. You deposited a check in the bank, but it's yet to be cleared. That could be one other reason. And that could be bank charges that's posted in your bank statement, but you did not record in your accounting records. And there could be errors too sometimes. Or it could be a transaction that you did not authorize, which got posted, or there were account maintenance charges that you weren't aware of, any fees for certain activity that you did not authorize. So those are some things you will catch when you do your bank reconciliation. We will cover what is the frequency and the recommended approach for all of this. The major one is that caused the difference is you issued a check and it's still not being presented. So your accounting records will show a lower balance compared to the bank statement. So that is one of the major ones, but there are a few others like we covered here. So what are the accounts that needs to be reconciled? It is not always just the bank statement. When it comes to reconciliation on a frequent basis for your business, it's your checking account, saving account. If you have loans for your business, reconciling your loan balances between your accounting records and also the bank statements. So it's loans, line of credits, if you have any mortgage or any term loan, any financial transactions, any financial loan account or checking account, saving account you have for your business and you're working with the banking institutions. So they provide you statements on a regular basis. You have to make sure you are reconciling those statement balance to what you show in your accounting records. So now, what is the importance of bank reconciliation? Number one is to catch fraud before it's too late. The fraud can happen in two ways. One, staff fraud. If you have someone in your business, your staff record the bank transaction, have access to your bank account, they might be making unauthorized payments or stealing money. You would not know that unless a bank reconciliation is performed and reviewed by you frequently. So if you don't catch it early, say if you find it out a year later, and it's really too late to fix those errors, by the time you might have lost a lot more money. So if there's any fraud happening, but through a regular frequency of reconciling a bank statement, you can catch those fraudulent transactions very quickly. So one is the internal fraud by your staff, another is an external fraud. That's where if someone access to your bank account and spent money from your bank account, so it's unauthorized transactions or checks that you see in your bank account which is not approved or authorized by you, and any withdrawals that you don't recognize, or you deposited a check but it's still not showing up in your bank account, missing deposit, or you find transfers from your bank account to another account, which again you did not authorize those. So all of these things can happen, both due to internal reasons or could be external reasons. Internal could be your staff, and external could be happening from the bank, or someone got access to your account and posting unauthorized transactions. So all these things you will find out only if you do a reconciliation. The reconciliation could be done by your staff, but you have to make sure as a business owner you are reviewing or you're looking at those reconciliations on a frequent basis. That's the key. And number two, the importance of bank reconciliation is catching any errors. These can happen in case of a bounce check. You presented a check in your bank account, but from your customer, but the check didn't clear. You would not know until you do a reconciliation. You might have assumed as once you deposited the check it got cleared, but you will only know when you do the reconciliation that whether it was cleared or not. There could be bank fees for insufficient funds, or could be monthly maintenance charges. You have a check that got bounced, so non-sufficient balance got fees, or your customer check you presented, it got bounced and there are charges in your bank account which you didn't know of, and there could be some statement charges. There are all of these fees posted by the bank. It's not something that you know and you would not have recorded in your accounting records. So those are something you will catch when you do the reconciliation. And number one, you are first confirming yes, those charges are legit. If not, you will have to talk to the bank to dispute those fees and charges and get it refunded. If you recognize those transactions, then the obvious action is you're recording those in your accounting record, so your accounting record balance matches with your bank statement. So doing a bank reconciliation helps you catch all of these missing information and fraudulent transactions. And also making sure you doing a bank reconciliation, make sure you are recording all of the expenses in your financial statement. That helps you making sure that you are taking all of the deductions appropriate in when you file your tax return. If you don't reconcile your bank statement, you might be missing all these charges, and the fraudulent activities are not caught and you haven't cleaned that up. So you may not be taking all of the legitimate expenses that you paid for from your business. If without doing a bank reconciliation, you might be missing them, which can result in claiming low expenses when you file your tax return. Now let's find out what is the frequency in which the bank reconciliation needs to be done. So I highly recommend all our clients and the small business owners to at least reconcile your bank statements on a monthly basis. That is the minimum recommended frequency. If you have the staff and the time to do it, you can do it more often than that. But bare minimum, you should be reconciling your bank statements or loan statements or line of credit term loan on a monthly basis. In addition to reconciling, I would also recommend as a small business owner checking the activity in your bank account at least on a weekly basis. Just go in and go to our banking online portal and check what transactions are posted there. It doesn't have to be a reconciliation, but just checking to make sure you recognize those payments that are there, you recognize those deposits. Having a quick check, few minutes check on a weekly basis definitely helps. So again, you can detect some of the errors or fraudulent activity much quicker than waiting to do the reconciliation until the end of the month. So that's one thing we highly recommend our clients to do as well. So what are the benefits of bank reconciliation? We covered the importance, what's the bank reconciliation, what happens if we don't do it. So if you follow all of this, what is the benefit that you get by having a good bank reconciliation? Number one, it gives you as a business owner the confidence that the cash balance you see in your bank account is really the actual cash that you have in your business. That could be different. The major one, like we mentioned, could be issued checks, but it's still not showing up in your bank account. Other than that, your bank balance should represent the actual cash that you have in your business. So it gives you the confidence you are looking at the right numbers when you look at the bank balance. And number two, having the reconciliation done on a frequent basis, not just for your current account, the checking or savings account, but also for your loans and line of credits, term loans, all of that. Having that reconciliation and reflecting that in your financial records gives the confidence to, if you're working with an external investor, when an investor looks at your financial statement, it gives them the confidence that the numbers you represent in your financial statement is accurate. So for external investor purposes and for tax return as well, like I mentioned previously, if you have done the reconciliation, you are 100% sure you have taken all of the expenses, therefore the proper deductions in your tax returns. You haven't missed out any deductions, or so your tax return filing is accurate. Your financial statement looks accurate and gives confidence to your investors, or even if you have a bank loan, bank might be asking you for those financial statements as well. Any external investor or banking or any external stakeholder who is looking at your business will have confidence knowing you are doing all of these reconciliation on a frequent basis and your numbers are accurate. So these are some of the reasons why you have to do a bank reconciliation and why you have to do it more frequently. Thanks for watching this video, and if you like this video, please make sure to subscribe to our YouTube channel, and don't forget to click on the bell icon so you will be notified when we produce more videos in the future. If you like it, please share with your friends as well so they can get benefit from watching this video. Thanks for watching. I will see you in the next video.